Hey, what's going on guys? My name is Tanner and welcome to Crypto Bible. I have yet another highly educational, highly informative video for you. And today is something that we use all the time. It's something that we do trading pairs with as well. It's something that we hold in our wallets all the time, but we never really understand what they are, what their use is for. So today I'm going to be talking about what a stablecoin is and what it is actually used for, where they come from, what type of stablecoins there are. There's actually a lot more to it than people actually think. So that is what we're going to be covering in today's video. As usual guys, please be sure to leave a like down below and make sure you have subscribed already if you haven't and your bell icon is turned on. These presentations will be available to download on our website. The link to our website is in the description below, and as usual you can find all of our other videos up there as well as news updates and all of the prices and tickers of all of the other coins available on our website too. We are improving it day by day, so any other suggestions that you guys have about our website, please be sure to leave them in the comments down below, as well as any other educational videos that you would like me to present to you. And without further ado guys, let's get into it. So what is a stablecoin and how do you use them? A stablecoin is essentially a cryptocurrency designed to have low price volatility. Stablecoins are used as stores of values or units of account, as well as in other use cases where volatile cryptocurrencies may be less desirable. Different stablecoins use different strategies to achieve price stability. Some are centralized, others are decentralized. Since their inception, cryptocurrencies have been considered particularly volatile investment instruments when it comes to their price. That's led to price jumps and crashes, preventing cryptocurrencies from being used for everyday goods and services in some cases due to the risk for vendors and merchants. That's where a stablecoin comes in. The theory goes, if you create a currency that is pegged or attached to a regular fiat currency like the US dollar or something else with a relatively stable price, it will prevent price swings. So what is a stablecoin? Stablecoins are cryptocurrencies that claim to be backed by fiat currencies such as dollars, pounds, shekels or rubles, etc. The idea is that unlike cryptocurrencies like Bitcoin, stablecoins' price remains steady in accordance to whichever fiat currency backs them. What are some examples of stablecoins then? So you have centralized stablecoins, and it's probably one of the most popular ones as well, known as Tether, also known as USDT. Tether is one of the first stablecoins and the most famous. It claims it is backed by a reserve of real dollars, collateral that is off-chain, i.e. in a real-world location that is controlled by centralized third party. With this stash safely in the vault of a bank, investors can be confident that their tethers really are worth $1 each, keeping the price steady. The stablecoin accounts for a whopping 48% of all cryptocurrency trading volume. There's only one problem. Tether Limited, which mints Tether tokens, has never conclusively proven that the currency is really fully backed, fueling doubts among investors. You also have gold-backed stablecoins. While the vast majority of stablecoins are backed by the US dollar stored in a bank vault, weakening sentiment around the USD and the fiat in general has led to the stablecoin of elaboration backed by other assets, including various gold-backed cryptocurrencies. These differ considerably in the form of usability, but are all backed by investment-grade gold. You have Cash Gold, or CGT, is among the most popular of these. Each CGT is backed by 1 gram of pure gold held in the vault stored around the world. Sending CGT tokens is the equivalent of sending 1 gram of gold per token, since they can be easily redeemed for physical gold at any time. Then you have algorithmic stablecoins. Something like Terra UST, which has just recently come into the market, is a decentralized stablecoin, which means rather than relying on a trusted third party, it uses a complex algorithm to keep stable. To do this, it balances on-chain reserves. The funds are held in smart contracts with the supply and demand automatically mitigating the chances of traders accidentally or intentionally fiddling the price. A comprehensive list of popular stablecoins, or USD pegged. So these are the ones that you see down below here. You have Tether USDT, True USD, Terra Luna UST, Gemini Dollar, the USD Coin, Paxos Standard, Binance USD, another popular one also known as BUSD, DAI, HUSD, SUSD, Stable USD, and Ample Forth as well. So how are stablecoins used? Like most digital assets, stablecoins are primarily used as a store of value and is a medium of the exchange. They give traders temporary reprieve from volatility when the market is tumbling and can also be used in a rapidly growing world of decentralized finance, also known as DeFi, for things like yield farming, lending, and liquidity prevention. Most traders and investors gain exposure to the stablecoins by purchasing them from the exchange platforms, but it's also often possible to mint fresh stablecoins by depositing the requisite collateral with the issuing company. Again, just to kind of put that into layman's terms, what stablecoins are mainly used for is whenever the price of something is tumbling down or the market is red, traders usually tend to swap their tokens, whatever they are holding, into a stablecoin like USDT or UST, BUSD, like the Binance coin as well, simply to keep their price steady so they're not actually losing any money. And then whenever they believe the price is going to start going up again, they could trade it back into the currency or the cryptocurrency that they were holding before. So that is essentially what it's most popularly used for. That's definitely what I tend to use it for sometimes as well. But as you've seen in the slide, it can be used for so many other things as well. So let's get back into it. Why have stablecoins become so popular? Stablecoins are enormously popular. Tether, for instance, is the second most traded cryptocurrency after Bitcoin, with a 24-hour trading volume of $46 billion at the time of filming this. The two main reasons why people choose stablecoins over cryptocurrencies like Bitcoin: they're relatively stable. Because they're supposedly backed by fiat currencies, investors can be confident that their tokens will always sell for $1 each. This supposedly means that the prices won't fall. Coin prices are driven by belief, so if investors believe their stablecoin are worth and backed by $1 each, the price should reflect that. They're safe haven for the worried investors. Many exchanges, including Binance, the world's largest, don't let traders buy fiat currency and only let them buy and sell cryptocurrencies. This means it's often tricky for investors to swiftly cash out their cryptocurrencies when the going gets tough. To do this they might need to transfer across several exchanges or even wait several days. This is where a stablecoin comes in. Because they are cryptocurrencies, they live on most exchanges, yet because they adhere to the value of a single fiat currency, they act as a sort of temporary refuge for investors looking to secure their funds during a bear market. In this way, stablecoins are like blockchain-enabled versions of the dollar. That's if they retain their value. What are the disadvantages of stablecoins though? Investors need proof the coins are backed by reserves. In Tether's case, this has never been conclusively provided, sparking rumors that the currency was unbacked and was in fact minted out of thin air. Stablecoins aren't necessarily stable. The Gemini dollar has increased by a few cents several times in the last year as traders poured money into it. Ironically, many of those investors' funds had come from Tether, which has previously sunk to as low as 51 cents on some exchanges. As such, stablecoins can be considered relatively stable rather than absolutely stable, particularly when compared to volatile assets like Bitcoin. But what is the future of stablecoins? With the crypto boom of 2017 behind us, investors are increasingly looking to stablecoins as a safer way to experiment with the technology. In the first half of 2020, the supply of stablecoins swelled by 94% to hit $11 billion in June last year. And regulators are warming up to them too. In September 2020, the US Office of the Comptroller of the Currency, OCC, gave national banks and federal savings associations the green light to hold reserves for stablecoin issuers. As more respected players throw in their weight, the Winklevoss twins, Circle and Coinbase, for instance, the idea of a digital dollar, a shadow currency that takes fiat onto the blockchain without risking its value, is ever more tantalizing. And guys, that's going to cover it for today's video. I hope you have learned what a stablecoin actually is, what they actually do, what are they used for, the different types of stablecoins as well. And as you saw in one of those slides, there's loads of them. The majority are backed or pegged to the US dollar is what they say. So yeah, that's basically going to cover it for today's video. If you have enjoyed it, make sure you are leaving a like down below and you are subscribing if you haven't already. Ensure your bell icon is also turned on. And as usual, guys, you can find these presentations, like I said, on our website amongst so many other things too. So make sure you're checking it out. The link to that is in the description below. And I hope you guys have enjoyed, and I'll see you very, very soon. Take it easy.